Hello and welcome to the Bulletin with UBS on Monocle Radio. Each week, the sharpest minds and freshest thinkers in finance take you beyond the numbers and hype, right to the heart of the big issues of the day. This week, we bring you the latest instalment in our ElectionWatch series. This programme's companion pieces to the series of reports of the same name from the CIO of UBS Global Wealth Management that look ahead to November's potentially seismic general election in the United States. In today's edition, we're dipping into the recent ElectionWatch piece, subtitled Scenarios and Implications of the US Election for Europe. As we'll hear, as the vote draws ever closer into focus, there are potentially two key issues coming to the fore for European investors, businesses and politicians alike: trade and defence. Let's start the programme with the macro view from Bulletin regular Dean Turner. Dean's European economist at UBS Wealth Management. Good to have you back with us once again, Dean. Always interesting when we dive into the ElectionWatch pieces from the UBS CIO, and often we actually talk to colleagues, obviously, in the US who are right in the midst of that story. Really interestingly this week, we're actually looking at some scenarios, some of the implications of that critical general election in November for Europe. So, as a European economist, super interesting to get your take. And let's talk about the economy first of all. Obviously, we know about the links. We know how significant what happens in the world's biggest economy is for everybody. But give us a sense from the conversations you have with your colleagues and with clients exactly how sort of immediate the impact as we tick towards November is likely to be or not on the side of the pond.
I think that investors are clearly focusing on events coming in November, but we have to be aware that the economic implications will take time to filter through. And there's a couple of reasons for that. The first is if you think about the main trade linkages between Europe and the US, it will principally be via the trade channel. The US is an extremely important trade partner for the continent of Europe, so any changes there will affect Europe, but these will only happen in time. I think the other thing that investors are focused on is clearly some of the aspects around foreign policy. These do have the potential to have an economic impact in time. But again, it's very much a story of perhaps thinking about the middle of 2025 and beyond rather than events in November.
Yeah, absolutely. Well, in a moment, I'll ask you, Dean, a little bit more about some particular scenarios, because I think what the report does, which is, well, it's always interesting to read about, is look at, the combinations of outcomes, Democrat win, but splits in the chambers of Congress and so forth. But just in terms of on that policy side, because the report, quite near the top, it talks about defence and how that is an area where almost come what may, Europe may well be in a position where it needs to think about how it funds defending itself. Again, not to get too bogged down in the detail, but that is something that is very relevant, that slightly kind of almost sits without that, the other policy considerations maybe?
Well, look, the thing around defence is that it is not a new story that Europe is going to have to spend more money on defending itself over the coming decades. This is a trend that's already underway. I think where the election could potentially have an influence is really just around the speed of that adjustment. We know we're on that road. We know defence spending is increasing, but how quickly that has to happen is clearly the area of focus that could result from the election.
Yeah, absolutely. Well, let's talk a bit then about scenarios. What's the best way to break this down in? It's interesting if we look at what we expect to see then in terms of, I guess, if the incumbent is returned again, is it an oversimplification to say, well, then we would expect if Biden wins that there's greater consistency? I mean, it seems obvious, but I guess that is probably likely both in policy terms and maybe in macro terms?
I think, look, from an economic perspective, if we see that it's a Biden presidency, we would expect the economic outlook to remain broadly unchanged. And that is for a US economy that is gradually slowing as we go through the end of this year and into 2025. That's also a policy environment in which we can see the US Federal Reserve begin to lower interest rates. Now, the only nuances around that would be that if Biden doesn't have control of the upper house, which is the case today, then the scope for material fiscal changes will be limited. So, the reality is it's probably very, very similar to the situation that we're facing currently.
Yeah, interesting. And what about Trump? I mean, we often talk with yourself and with colleagues from all across UBS actually about how, it's difficult to sort of price in market terms political uncertainty. And with Trump, I guess not only have you got the big unanswered question, does he win or does he not? But, he is himself an enigmatic and unpredictable figure. So does that make it harder to make those kind of predictions? Or actually, there's not so much margin for error, do you think?
But the view we take on this is that what's going to be the main area of focus for us. It's what impact will the presidency have on the economy, and it really comes down to one area when it comes to the US economy, and that's going to be fiscal policy, and to call it what it is, it's levels of taxation. Now, if Trump becomes president and we see a situation where he doesn't have control of the upper house, the scope for the president to make meaningful changes to fiscal policy will be quite limited. We would expect at the margin, perhaps, that he will push through some more economically growth-friendly measures. So it's not unreasonable to assume that the forecast for economic growth could be a little bit higher in the short term, but not to the extent that it would really change the bigger picture. I suppose it's fair to say that if we have got a bit more volatility in terms of the outlook for growth and for some aspects of domestic policy, that could mean that inflationary pressures could be a little bit more persistent for longer. But again, I would say that's to a material extent. What we're suggesting here is marginal. Potentially, a bigger change could come if we were to get what we call a red sweep, so that's control of the upper house as well. And then clearly the scope for the new president to implement some of his favoured policies, which seem to be focused on lowering taxes, would come into focus. If the new president was able to lower taxes, then look, other things being equal, lower taxes will result in a short-term boost to growth. But even there, we would be sceptical of how far that can go. And the reason for that is that the US's fiscal situation, whilst it's far from being precarious, it's certainly not in the best shape it could be at the moment. So that would suggest to us that yes, there's upside risk in terms of movements in tax policy, but again, it's very unlikely to be to a very meaningful extent because of the present fiscal situation.
Yeah, absolutely, Dean. Well, let me just ask you about a Forex question just quickly, because I guess, especially if we look transatlantic, if we look at the euro outlook, I guess it's sort of contingent more on what the general election stateside means for interest rates on that side of the pond, right? That would be more impactful, and US growth outlook more broadly. That's probably the key thing which will shape the euro picture, right?
Well, look, the FX market's going to continue to be dominated by the US dollar. So you're absolutely right that that's where the election result comes into play. I'll just make a couple of observations here, and that's that, irrespective of the outcome of this election, it's quite likely that the US Federal Reserve will cut interest rates later than what we're likely to see from the ECB. We expect the ECB to go as soon as June. If in the US we were to see growth a little bit higher, inflation a little bit stickier, then clearly that would delay the Fed cuts, and that would be broadly supportive for the US dollar. I think the other thing to bear in mind as well is that if we were to see an increase in uncertainty, that's typically an environment that favours the US dollar relative to other currencies and other more cyclical currencies, I should say, such as the euro. The third angle as well is trade. And we've got to bear in mind that there's a lot of talk around trade tariffs from both parties. We shouldn't forget the fact that President Biden has recently implemented some increase in trade tariffs himself. So it's not like that we're going to see a dramatic change of direction as a result of the election. But clearly, the magnitude for further noise around trade could also be a factor that has an influence. And for a region like Europe that is heavily dependent on trade, we're a current account surplus region. Any further volatility or noise we see there would also be a negative. So look, net, I think as we're going into the election, it's very hard to see how we're going to see dollar strength broken. Now, look, as we move into 2025, everything's up for play, and, other things being equal, we would expect that the euro can stage some modest recovery against what will principally be driven by a weaker dollar. But ultimately, I think that's a post-election event. Up until then, the level of uncertainty and what's happening with central banks probably favours the dollar for the time being.
Dean Turner. Well, next up, let's dip into what the ElectionWatch piece has to say about the fixed income and credit picture with Thomas Wacker, head CIO Credit. Thomas is responsible for fixed income and bottom-up credit globally. Thomas, welcome back to the show. We're talking about the impact of the US general election on this side of the pond. So let's get into that. You look after fixed income, credit. Let's talk a little bit about, well, first of all, just give us a sense of how easy or difficult it is to look at these areas and try and think about outcomes. When you're talking about something which is pretty unpredictable, politically, potentially quite volatile, presumably you and your colleagues have your work cut out.
Yeah, and obviously the world of fixed income is already complicated enough these days, right? With inflation being stubbornly high and even has been increasing recently in the US again. So we all still grapple with when exactly we're going to see central banks cutting rates. For Europe, at least, we've seen a starter. The Swiss National Bank has cut rates already and should keep doing so. Also ECB, we're quite confident we'll get in summer. But the US, of course, is the leading one globally, and their rate cut expectations have been pushed back by what has been happening in the US economy, with that persistent strength of the labor market, and as a consequence, that persistent inflation. So this is, of course, already the big question mark for fixed income. We still think the Fed will cut ahead of the election and keep cutting subsequently. So we think fixed income is an attractive asset class to be invested in. The yields are pretty much at decade level highs. And we think yield curves will gradually come down in the next 6 to 12 months. And obviously that should give us sound total returns for bonds. Also between Europe and the US, obviously yields tend to move pretty much in line on the way up and down. However, we think now this recent move has been a lot more pronounced in the US, and it's probably going to continue to be more volatile in the US than in Europe.
Well, Thomas, let's look a little bit, not, I guess, at specific scenarios, Biden wins, Trump wins, and what happens or what they then do. But what about the impact of that? And I guess that's interesting, first of all. What is the nature of the cause and effect? Because often a lot of the commentary is about the huge difference between the two. But often for investors, sometimes the kind of the difference actually isn't as profound. But how immediate and how deep an impact do you expect to see in your areas of focus, depending on the actual outcome of the vote itself?
So obviously there's always, like in this case where you have either an incumbent or a change. The thing is, of course, that, for example, if Biden were to win, it's likely a continuity. So it's likely in line with what we already see when it comes to policies and the impact on the economy. So it's not necessarily something that would make us change our view on inflation, on the government deficit a lot, and that would essentially support the positioning that we've currently chosen to pick higher quality in medium tenors. That's the area that we think would benefit most in a continuity scenario.
Conversely, I guess, the opposite of the continuity is the change. And, there's always uncertainty with a new or returning protagonist. But of course, with Trump in particular, he is, by his nature, particularly unpredictable. Presumably that makes it slightly more tricky than it might otherwise have been.
It clearly introduces a degree of uncertainty. Obviously, there's many expectations out there what sort of policies could be adopted, but we really don't know. And obviously, it's not just the president. Obviously, we need to see what Congress does and if Congress would support certain measures. So that is all a lot more uncertain, and credit is an asset class that doesn't like uncertainty. So it tends to react to higher uncertainty with wider risk premiums. So this would also underpin a bit more defensive positioning into it. So not necessarily being in weaker credits, or like in the areas like high yield. So we would pick higher quality generally, and also looking at least what has been said, what we know from the last term, we think chances are that the measures that would be taken would lead to even higher, I have to say, government deficits. We already have extremely high US deficits, but they could be growing further if you see significant tax cuts and not a lot of revenue measures against this. What's also important for the fixed income world is that we already see a lot of issuance of treasuries, and that could even increase further. And somebody has to buy those bonds. So we think even more supply could weigh on the performance, particularly of the treasury curve. The longer end could suffer from more supply. Inflation pressure is also something, if we see wider tax cuts, that could again fuel inflation, so make it more difficult for the Fed to ease. So another pressure that could potentially keep yields somewhat more elevated. So putting that together, what it tells us is we would retain the quality bias that we already have, but we would probably be with somewhat shorter tenors, so on the shorter end of the curve, where we're not that vulnerable to this potential upward pressure on bond yields.
Well, I guess, Thomas, just as a final thought then, I know you sort of outlined this in your opening remarks. Given the backdrop you've described, is it sort of safe-ish to say then that if we're talking about European fixed income markets, the expectation then, in a way, kind of pretty much whatever the stripes of the winner in November is stateside, we'd remain broadly confident, pretty solid total returns overall? Am I kind of oversimplifying, or that's kind of the takeaway?
Yes, it is. One of the key advantages we're having at this juncture is that we get some yield, right? We had a long period where yields, in particularly in Europe, have been very low, if not negative in the euro currency. So at least now we have some interesting carry yield to earn, and that clearly puts us in a better place for the asset class. And obviously we have that option that yields could decline faster. There's a lot of other things going on aside from the US elections. We have a lot of geopolitical risk, and any events that lead to a risk-off environment typically lead to a flight to quality. So are supportive of bonds. And that obviously makes it an appealing outlook also from a portfolio perspective.
Thomas Wacker, bringing us to the end of this edition of the Bulletin with UBS, setting the agenda in the fast-moving world of finance each week here on Monocle Radio. You can listen again and explore more at monocle.com. You can also follow the programme wherever you get your podcasts. As ever, you can discover more, dive a little deeper, and find out how UBS can help you by heading to ubs.com. This is the Bulletin with UBS on Monocle Radio. I'm Tom Edwards. Thanks for listening.